Hello, everyone, and welcome to our Ideas Edition podcast. And I am so excited for this particular podcast because we don't get to talk a lot about retirement solutions. And today I have a special guest that came from Equis Financial, which is our life insurance division, IMO. And his name is Bill Martin. He's actually the VP, Vice President of Retirement Solutions Division at Equis Financial. Bill, I'm so excited to have you here. Welcome to my podcast.
Well, thanks for having me. It's exciting to be here.
It is. And thank you for traveling because you came all the way from
St. Louis.
St. Louis, Missouri.
Yeah.
Man, that's how far was that drive? I mean, that flyover here.
Well, I flew to Fort Myers first because we have a winter home there. And checked on that, and then I drove up the 3 hours from Fort Myers.
From Fort Myers to here.
But that's about a 2 hour and 15-minute flight from St. Louis to Fort Myers, so you can watch a movie.
That's good.
Uh-huh.
That's good. Well, thank you for being here. I know your time is valuable, and you know, we don't get to talk a lot about retirement, and it's so important that people understand, you know, how to save for retirement and how our products can actually help them. But before we get into that topic, tell me a little bit about you and how you got started in the insurance business and you know, especially working providing retirement solutions for clients.
Well, you know, it's been a long journey. I just celebrated my 25th anniversary of being in this business.
25th year.
Yeah.
Wow.
So I was 12 when I got my insurance license.
No way.
But no, I was 24.
24.
And I went to college at Southern Illinois University, where I majored in hotel, restaurant, and travel administration. I just wanted to be in business. I thought, well, if I choose a general business major in college, that's what everybody does that when they don't know what they want to do. So I thought, hotel sounds fun. Mm-hmm. So I got a degree in that, and I hated it. From the second I started working, I hated it. I wasn't making any money. My starting salary was $25,000 a year.
Wow.
Now, this is 28 years ago, but there still wasn't very much money back then either.
Yeah.
And my wife and I got married a month after I graduated from college. Okay. We got pregnant 3 months after we got married.
That was fast.
Yes. And so here I am working in this new career. I've got a young baby. And what do I want to do? I want to make money, and so that I can give her everything that she needs and wants so I can save for college. And I want freedom and flexibility so that when she's got a doctor's appointment or when she starts playing soccer down the road or going to school, whatever, I've got the freedom and flexibility to be able to spend that kind of time. And in that hotel business, it was very strict and rigid. I had to be there about 6 a.m. to open up the restaurant. I was there 12 to 14 hours every day and getting yelled at nonstop because one of my employees forgot to this or forgot to that. And so I lasted about 2.5 years before I got out. Now, I realized that if I wanted to make some money and have freedom and flexibility in my life, I needed to get into sales. So I spent a year looking at different sales opportunities and interviewing. Couldn't find anything I really felt like I could believe in. And then this guy that was working with my wife tried to recruit her to do insurance sales. And she was right at the start of the refinance boom. Interest rates were dropping, and she was doing a lot of, she was a loan officer. She was doing a lot of refinancing of mortgages. And she said, I'm happy, but my husband probably want to talk to you. So he introduced the concept of mortgage protection to me, writing a life insurance policy that would pay off the house for the client if they were to die or, whatever. So I thought that sounds pretty awesome. And I got my insurance license. A month later, I quit the hotel business. I gave him a month's notice. I gave him plenty of notice.
Yeah.
And then I jumped in head first, didn't go part-time, just jumped in head first and started doing mortgage protection.
Full time.
Yeah. Right out of the gate. And it was a little stressful. If I could go back and do that again, I might have created more of a transition period and done it part-time for a few months. But of course, knowing now what I know then, I would have jumped in and been a lot better at this than I was when I got started.
Of course, yeah.
So it wasn't for a good, so here I'm 24 years old. I don't know anything about anything when it comes to insurance. I just, learned how to pass the test. But about a year and a half in, I started hearing about other people that were doing mortgage protection that were, cross-selling, and they would talk to their clients about, hey, by the way, now that I help protect your mortgage, if you die, we can get that thing paid off for your family. But, tell me about your retirement funding. Are you happy with the risks that you're taking? Are you happy with the returns that you're getting? Well, this was back in the early 2000s when the S&P 500 dropped in 2001, 2002, and 2003. Or was it 2000, 2001, 2002? I think those were the 3 years in a row the S&P 500 dropped. And so a lot of people were like watching their retirement savings, go away. And so people were cross-selling a lot of annuities. And I was like, well, I don't really even understand annuities. So my wife had gotten into the business with me about 3 months after I got my insurance license, and we were partners. And she said, you're going to learn how to sell annuities, and I'm going to hand feed you a ton of them from my mortgage protection appointments.
Wow.
And I said, okay. So I self-studied, probably asked Pete Lee a lot of questions because I was working with him at a previous company.
Wow.
He was the running our broker-dealer at the time. So he was in charge of all the, mutual fund sales and all of that stuff. And I basically self-taught. And my wife finally in March of 2001 said, okay, tomorrow night, I just sold a mortgage protection appointment, and we'd made like $500 of commission probably off that one sale. And she goes, all right, I just sold one, and I talked to them about the retirement, and they are not happy with, they've got this old 401k from a previous job, and it's losing money. And I told them that there are programs out there where you can share in the gains of the stock market in the good years, but you don't have to lose anything, a penny at all, in the bad years. You could just take a zero in the bad years, but you can share in the gains in the good years. And they're interested. They think it sounds a little too good to be true, but they're interested. And I said, okay, so I'm getting kind of nervous, and I got to go there tomorrow night. I got to run this appointment. So I go. I explained the program. I didn't even know a tenth then of what I know now.
Wow.
Right? I mean, I just, it's got penalties for early withdrawal. It's got a cap of whatever the cap was at that time, maybe 11% on the S&P 500. And, you can't lose anything. I explained how it worked. They said, that sounds great. Where do we sign? I did a one-call close on rolling these people's old 401k. And, I made multiple, I'm not sure if I should say the exact figure, but I made over $20,000 of commission on that very first annuity that I ever sold.
Wow.
And I couldn't believe it. I mean, and that's not normal. Usually an annuity sale is not going to get you that much commission, but it was just a large one.
Large rollover.
And then I was hooked. Then I was like, I want to learn everything I can. I started learning about indexed universal life. I started selling more annuities. And, we've made, 6, maybe 7 figures, probably 7 figures in 25 years selling annuities over the years. So it's been very profitable.
That is an amazing story. And thank you for sharing. And I'm so glad you also mentioned that without too much experience, you went into the household, you kind of explained what you knew about it, and you were able to close it. A lot of agents, they don't want to do that until they get all the information,
and then they do nothing.
Expert, and then they never close them anyway. So
right.
So it's the importance of just taking action. Even if you don't have to know everything, you just take action. So
that's right.
So that is amazing. And then Bill, I've known you now for 3 years since I've been with Equis Financial, and you've been a very helpful guide as far as helping us agents with Index Universal Life and case scenarios, and just showcasing, how it works. And, I want you to maybe explain to the new agent or the regular agent, so what is an Index Universal Life? How does it work? Why is it important for retirements or to supplement your retirement income?
It's interesting. This is already the second time today I've had this conversation about this.
That's awesome.
So I had an Uber pick me up at 8:30 this morning to take me to the Fort Myers airport, where I rented a car and drove up to here today, to Orlando. And I was talking, the Uber driver was like, well, what do you do? I said, well, my wife and I have an life insurance business. And she goes, oh, life insurance is so important, and get the permanent stuff. Don't get the term, like the whole life, right? And I go, well, whole life's kind of an older, antiquated form of permanent insurance. I said, nowadays we do indexed universal life primarily. And then I kind of explained what I'm getting ready to tell you and the viewers here. But, the key is that a lot of people, when you think of life insurance, you really are thinking of death insurance. You're thinking, okay, life insurance is if somebody dies, it pays a death benefit to a beneficiary to replace the lost income or the lost earning potential of that deceased person. And so what you realize then, and most people, that's where their knowledge of life insurance stops. And so you could bring me any policy out there, any life insurance policy, and I can split that into two categories. It's either going to be a term insurance policy or it's going to be a permanent policy. And, I started out selling term insurance, and I didn't really understand permanent insurance. And so it's real simple. With permanent insurance, every time I make a premium payment, some of that premium that I pay covers the cost of the insurance, the internal charges that provide a death benefit or maybe living benefits while I'm alive, that kind of stuff. But then some of that premium payment goes into a little savings account that's inside the policy, and then that builds and grows over time based on what kind of a policy you have. Whole life grows based on dividends that the insurance company declares. Indexed universal life grows based on, like I was saying earlier on the annuity, the performance of certain indexes like the S&P 500. So if the S&P 500 goes up, you're sharing in the gains in those good years, but if it goes down, you don't lose anything in the bad years. And so having that vehicle, that engine, I should say, in the insurance vehicle, having that engine that builds that kind of cash in it, where that money in that savings account inside that policy is growing tax deferred, and it can be accessed tax free down the road if you do it in the form of a loan.
A loan, yeah.
And so people go, oh, loans, that's bad. That sounds like debt. They say you shouldn't have debt, right? Well, I would rather pay what right now is most policies are charging anywhere from 4.6 to maybe 5% interest on those loans than maybe, 15, 20, 25% taxes on those gains. And so, and the great thing about when you do a loan from the cash value inside of an insurance policy is you don't ever have to pay it back if you don't want to. People go, well, what's the payback schedule? Well, that's up to you. 1 month you want to pay $5, you can. If 1 month you want to pay nothing, you can. Great. 1 month you want to pay $200, you can. You pay it back however you want, because as I always joke around when I do my training classes, the insurance companies know that we're all, Ricky Bobby, if you ever saw the movie Talladega Nights with Will Ferrell, Ricky Bobby says, there's a 98% chance that all of us are going to die at some point in our life, and of course we're all going to, it's 100% chance. 100%, yeah. But, the insurance companies know that is true, and that if we die with an outstanding loan balance, they will just subtract that loan balance or any interest that might still be owed out of that death benefit. So you're in a situation there where you can get that money out tax-free, and if you don't want to pay it back, you don't have to. And so there's a lot of advanced applications and uses for permanent insurance beyond just, hey, if I die, it pays a death benefit, or while I'm living, it has living benefits for critical illness or terminal illness. The cash value in there can be used to pay for our children's college. In my case, my oldest daughter ended up getting a lot of scholarships and we didn't have to touch the cash value in her life insurance policy to help pay for her college. So we thought, all right, well, we'll use that to pay for her wedding. And then we were blessed enough, we made enough money that year that I didn't really ever have to tap into it to pay for her wedding.
Wow.
So now I have this, what's accumulated about, $40,000-$50,000 of cash value in this policy that I took out for her when she was 2 years old, right before I got in the business. I wasn't even the agent. I bought it from somebody else right before I got in the business. And now that can be, but I put that money away for me to help her if she needed it.
Yeah. And that's a blessing that you were able to do that at 2-year-old, right? Because the sooner you do it, or you do it on someone like your kids, the more it grows, right?
That's right.
And it has to do with maybe the cost of insurance, right? Can you explain that a little bit?
Absolutely. So, the younger we are, the cheaper it is to buy any kind of a life insurance policy. You take two people that are in identical health, they're both non-smokers, the younger one is always going to be cheaper. If they're both the same gender, both males or both females, the younger one's always going to be cheaper. So, you get somebody where there's a low cost of insurance. Well, spending $100 a month, a lot more of that $100 can get its way into the savings account inside the policy versus somebody who's, maybe 40 or 50 years old. Most of that $100 is going to get eaten up by the cost of the insurance, and not as much is going to make its way into the savings account. So, fast forward, to the end of that, we never needed to touch that money to help pay for things we were going to pay for, college or wedding. So now I've got that sitting there. If I decide I want to go buy a new car, I'm going to grab that money and go, use that as my bank to go pay for that car.
Awesome.
You can use that cash value for retirement. You can use it for an emergency. A storm comes along and does a lot of damage and the insurance company only pays so much. You could pull that money out for an emergency to help get through it, because unlike a retirement plan where you have to wait till you're 59 and a half to touch it without a tax penalty, with the life insurance, it can be touched at any age as long as there's some amount of cash value in there. So super flexible asset. And when we start training on it and then the light bulb goes off for agents, they just start incorporating it into everything that they do. They're selling Medicare, they're selling mortgage protection, whatever it might be, because they get so excited about all the things that it can do for you.
Yeah. And it's crazy what you said, because, when you go to the bank to ask for a loan, you got to fill out all this big application. They check your credit. They check a lot of stuff to see if you can get the loan. With life insurance, there's none of that, right?
None of it.
You just go there, whatever you have there, they'll let you loan it, and then it's so much better. It's such a great vehicle. And there's a lot of misconception out there between IULs or regular mutual funds. What are some of the advantages maybe of an IUL? I don't know if there's any disadvantages. Maybe you can go over that, advantages and disadvantages. Maybe it's just advantages, right? But
mostly, to me, it's mostly pros. And by the way, when I say what I'm going to say, I own stocks, I own mutual funds, I own exchange-traded funds. I have all kinds of different investments. To me, life insurance is an asset class. It's just one other place to save money, to diversify.
Awesome.
Now, the advantages are that if you're using indexed universal life as the vehicle, you're never going to lose money in the years where the market has a downturn. You're going to share in the gains in the good years, usually up to about 12% at the most, but you're never going to lose a penny in those bad years. So that's a huge advantage right there.
So if the S&P goes down 10%, zero.
You lose nothing. That's right.
That's huge. So that's how an IUL works.
That's right.
Okay.
Yeah.
But if it goes up 15, 20%, then there's that cap where it could be 12% that it will be interest credited to the policy.
I was just talking to an existing client of ours last night who has bought, 15, 16, 18 years ago, bought 2 term policies. And I was saying, you really need to get something permanent. And I was explaining indexed universal life. And I said, because there is a floor of 0, there's also a ceiling. And that's people understand that because you get the benefit of the floor, you're not going to be able to get, if the market goes up 20%, you're probably not going to get that. But 12% isn't bad. And I told them, I said, if something, like in 2008 when we had the financial crisis around the globe, the S&P 500 dropped 40%.
Yeah, that was crazy.
Now, how much did it have to go back up just to break back to even? It went down 40. It had to go up 67%.
Oh my goodness.
Just to get back to even. So some people real quick would say, oh, it went down 40, it's got to go back up 40. Well, if it goes back up 40, it still hasn't broke back to even. it has to go up 67% just to get back to where it started before it lost the 40. And so with IULs, you don't have that making up negative compound interest, because in a year, it grows, and then in a year where the market goes down, it just goes flat. And then right when it starts going back up again, you take off from where it left off. You're not having to make up the negative compound interest.
Wow.
Yeah.
That is huge.
Yeah,
That
big
is
time.
huge. And that's how sometimes it can beat the market. These type of products beat the market because of that.
With index products, I always tell my customers, we're not trying to outguess, outperform, or outthink the market. We're not trying to do all those things. In the long run, if you choose, some, pretty decent investments, in the long run, the market will probably do better. Probably. Now, there's case studies out there for shorter durations where, over the course of you could see 10 years and 15-year windows where these index products actually performed better. But in the long run, it probably won't. So, the question is, where is a client in their life with regard to, getting closer to retirement? As we get closer to retirement, we need to take that risk down.
Mm-hmm.
And that's where index products, annuities or universal life, either one, can be a great place to do that, take that risk away. Now, I will say so what are the cons? There's pros and cons, right? Are there any disadvantages or cons to an IUL? They're not great short-term vehicles. If somebody says, hey, I want to put money away for 5 years and pull it back out, these are longer-term vehicles. There's a lot of, you got to understand, it's wrapped in this life insurance wrapper. Okay. So if I take out let's say a $250,000 death benefit, and I pay a $200, I'm just making up a number, a $200 premium into that for a few years, the insurance company is on the hook for a lot more risk if I die during those first few years. So in the first 10 years of most permanent life insurance contracts, there are heavier fees and heavier expenses that kind of start to go away after 10 years typically. So IULs are not great short-term vehicles. They're fantastic long-term vehicles. And what I always explain to people is, you could go get me, right in 2019, my wife and I bought some Tesla stock.
Awesome. She
She has a Tesla. And she loves it. So she says, we should buy the stock. And I said, all right. So we bought some stock, and we've gotten I want to say a 500% return on that investment. It's done very well.
Much, I know.
So an IUL is not going to beat that, right? But I'll have to pay capital gains tax on that when I sell that Tesla stock.
Mm-hmm.
I'm not going to have to do that in an IUL. And even though IUL might not be the absolute 100% best accumulation vehicle, it is the absolute 100% best distribution vehicle.
Wow.
And let me explain that.
Yeah.
So if I take out a loan from my policy and they charge me 4.5% interest on that loan, well, let's say that my IUL earns, the S&P 500 has a good year, and my IUL earns 9% that year. So it earned 9%, but the loan charge on the money, let's say I had $100,000 in my cash value of my IUL, and I took $10,000 out.
Yeah.
So they're going to charge me 4.5% interest on that $10,000, right?
Yeah.
Well, what they're actually going to do is, because the market went up 9, but they're charging 4.5, they're going to subtract the difference.
Okay.
So the difference is, well, I don't like that example because it gives you the same number twice. Let's say it went up 10%.
10%.
Okay. So that means that the interest charge would have been 4.5. It went up 10. The cash accumulation got a 10% growth. So what they're going to do on the $10,000 that I borrowed, they're going to pay me the difference between the 10% and the 4.5, which means I'm going to get a 5.5% interest credit on the money that I borrowed.
That's crazy.
They sent me the money. The insurance company sent me the money. Mm-hmm. I put it in my pocket. I spent it. I did whatever I did with it, and I'm still making 5.5% on it, even though it's, they sent it to me.
Yeah.
Right.
Yeah.
And so, even though life insurance is not the 100% absolute best accumulation vehicle, it is the 100% absolute best distribution vehicle, because where else can I save money, pull it out, and still get paid on it down the road? Nowhere. Right? Not legally that I know of. And so this is the only place you can do that. And so what I always tell my clients is, look, income is the outcome that matters most.
Yes.
Income is the outcome that matters most. Who cares if I can buy a stock or mutual fund and grow this huge pile of money? Who cares how big I get that if my smaller IUL pile of money pays out more over time?
Exactly.
Income is the outcome that matters most.
Love that, Bill. What's the ideal client for an IUL?
Oh,
what do you look for, like when, this will be a great candidate for an IUL?
Well, that's a great question, because an IUL is just about fantastic for anybody that's insurable. So a lot of times we get tricked as insurance agents, we get tricked into thinking that, well, I really want to look for younger people because I want to build them a ton of cash value in this product. And the younger they are, the better the cash value will grow if they don't need to get that till they're 65 or 70 in their retirement years. Look at how much more money, and that's true. They can grow this. The earlier you start, the more money you can grow in these things, and the better it's going to be. But remember, first and foremost, it is a life insurance product, which means there's a death benefit. And so, an IUL can still be fantastic for someone in their 50s or 60s or even 70s that just wants death benefit and still wants good cash, doesn't mind, the cash accumulation is a nice side benefit, but it's not the primary reason they're getting it.
Yeah.
So, because of the living benefits, because of you can grow the money tax deferred and then pull it out tax free if you do it right with the loans, because of the bonus benefits, which are, if you've got the living benefits, the terminal illness, chronic illness, critical illness, all these ways you can get the death benefit without having to have actually died. And the fact that the plan self-completes if you die, meaning that if I'm putting money into an IUL with the idea of pulling the cash back out into retirement when I'm in retirement someday, but I don't make it to retirement, I die before I get to retirement. That death benefit goes to my spouse, and now she's got her retirement covered because of that death benefit. So that means the plan's self-completed.
Exactly.
Yeah. So because of all of that, IUL is really a great vehicle for, just about anybody.
Wow.
Now, as far as, people that want to pull that money out tax-free, high income earners really, really, really like this once they understand it, because a lot of them make too much money to invest into a Roth IRA. And there's only 3 places you can put money away and be able to pull it out tax-free in the future. Municipal bonds, Roth products, so, Roth 401k, Roth IRA, et cetera, and permanent life insurance. Well, I always cross municipal bonds off because, they're not very well diversified. You're not gonna make a ton of money in a muni bond. Roth accounts can be great, but if you make too much money, you can't even contribute to a Roth account. And so permanent life insurance, you can put as much in as you want. You just have to have a certain amount of death benefit for the amount of money you're going to put into it.
Yeah.
But you don't have all the rules, like you got to wait till 59 and a half to pull it out like you do a Roth, stuff like that. So it's very ideal. Long answer to your question, but it's very ideal for just about everybody.
Wow. I love that. And then the other question we get asked a lot, okay, what's the ideal amount I should contribute towards these type of products, right? I know it has to do with age, right? And it has to do with saving for retirement, but how would you answer that question? Because I think it has a lot of answers.
You're right. And there's not a one size fits all, for sure. So what I would say to that is that, how much are you currently, Mr. Customer, putting away towards your retirement, and where are you contributing to your retirement? I want to find that out, because what I find a lot of people doing is making a huge mistake in one of the ways that they're saving for retirement before I meet them. And that is that we recommend, if you have a 401k through your job, go ahead and take advantage of that. But a lot of companies say, well, if you put in up to this amount, we'll match your contribution. But if you want to put in more than that amount, we're only going to match up to a certain level.
Yeah.
And some people maximum fund those 401ks all the way as much as they can. And what I would advise doing is only put into your 401k up to the match. And then if you're putting in more than that, instead of putting that in so you're going to have to pay tax on all of that when you pull it out someday.
Exactly.
Instead of doing that amount above your match, go ahead and have that paid out into your paycheck now. Pay taxes on it now while taxes are low, because we all believe taxes are going to be higher in the future.
Totally
Our
agree.
government debt problem that we have.
Yep.
And so have that paid out now while taxes are low, and now put that into a Roth account or an IUL and set yourself up with a tax-free bucket of money. So a lot of times I can find the initial contribution right there where we're not actually asking the client to come up with any additional money above what they're already saving. We're just reallocating what they're currently saving, taking some from their tax deferred in their 401k or whatever, and putting that into the tax-free account, which would be the IUL or the Roth. Now, once people see what this can potentially do, we can run illustrations with some of our different carriers and show them, hey, if this averages 6% per year, or maybe 6.5%, here's what you could expect, how this could grow. People see that, and next thing you know, they're going, so, hey, could I put in another, couple $100, or, then they start talking themselves into putting more money in there.
Yeah.
So, it all starts with, what are you currently putting away? And, is there anything extra that you think you can afford to put away? Because the sooner you start and the more you do, the better it's going to be.
I love that answer, because then you find out more information, because maybe you tell them 500, but reality that maybe they can put 1,000 after you ask those questions. So
that's right.
In order to maximize their retirement. So love that. Okay. Another question we get asked a lot. Okay. What's better, IUL or whole life? Or what would you say to that?
Well, this causes civil wars in the insurance industry. I've seen people like ready to shoot each other over this question. So, I'm a firm believer when it comes to life insurance that there is no one size fits all. People that get on there, people that have a big platform that we've all heard of, love to get out there sometimes and say, you should always buy term and invest the difference, or you should never buy indexed universal life, you should never buy whole life, you should never this, you should always that, whatever.
Yeah.
Everybody's situation is a little bit different.
Totally agree. Yeah.
So I will tell you, I do tend to be lean towards IULs, but I understand that in not every situation are they best. So what's the client's objectives? Is the client like the idea of having returns in their cash inside their policy linked to the stock market? Do they believe in the stock market in the long run, but they like the idea that they can share in the gains in the good years with never taking a loss in the bad years, the floor and the ceiling, or the floor and the ceiling? Do they like that idea, or are they more pessimistic about the market and they say, what, I'm the kind of guy that would rather just invest in a CD at a bank. I'm looking for safety. So for people that are they're a little more pessimistic about the market, looking for more safety and guarantees, I'm going to write them a beautiful whole life policy. But I find that's a very small percentage of the people I run across. Most people say, in the long run, I like the market. I just hate it on those years, 1 or 2 years where it drops. That makes me nervous. So this gives me, I can have joy during the good years, but I can rest easy during the bad years because I'm never going to take a loss. Those are great IUL candidates.
Awesome. Love that. All right. So, Bill, have you had a case scenario or maybe an actual client, because you've been doing this 25 years now, where you actually wrote the policy and then you've seen maybe the growth of that policy, or that client might call you to thank you because of like a real case scenario where, because we offer the illustration and we tell them, hey, this is how it's probably going to perform based on what the market has done in the last 30 years, right?
Right.
But actually, because you've been doing it for so long, can you share with us maybe a testimony of one of your clients where they actually got the growth that they wanted on one of these products?
So the first thing I'll say is this. Anytime I show an illustration to a customer, and I started out selling universal life before indexed universal life even really hit the streets. I mean, there was only one or two companies offering indexed universal life when I first started selling universal life. So I've sold a lot of permanent insurance, universal life, indexed universal life over the years. And every time I show an illustration, I always tell my customers, the one thing I can guarantee you about this illustration right here is that it's wrong. It's, this is not going to average exactly 6.25% per year or 7.25 or whatever the illustrated rate comes out to be.
Yeah.
You're going to have years where it might make 12%. You're going to have years where it might make 0%. So this is just kind of gives you an average based on history of what you should expect, but it will not be these exact numbers.
Got it.
And they go, okay, I get it. And so, I've had a number of customers, and they get their statements once a year, and sometimes they call, but Lori and I, my wife Lori, we've really tried hard to stay in front of. We've got 5,000 or 6,000 life insurance clients that we've developed over the years.
Wow.
And we try and stay in front of them as much as possible. We've recently done a much better job using some automation and some funnels where people can self-book their reviews, and we don't have to sit there and dial the phone, and and it just makes it a lot easier. And when I tell people in those reviews how much cash they have in some of these policies, I mean, sometimes they're just like, this one kid, I'll never forget this, that this wasn't a story of huge accumulation for this person, but it meant the world to this person.
Wow.
So my wife wrote a policy on a gentleman who was a grandfather, and he said, hey, I would like to do a policy on my grandson. And so she wrote a small IUL. I'm sure the premium was less than $100 a month.
Wow.
It was just small, something to get him some insurance and get some cash started. Well, that was probably, 10 years ago. Fast forward to earlier this year, he set an appointment, the grandson set an appointment to have a policy review. And I called him, and I got to looking at the file as I was getting ready to call him, and I realized he didn't take out this policy. Grandpa took out the policy. Maybe I should be talking to Grandpa. And now this kid's in his early 20s, right?
Wow.
And so I called him, and I said, hey, looks like your grandfather took out a policy on you, and thank you for booking the review, whatever. And he said, well, my grandfather died.
Wow.
And he said, so I took over the premiums. I said, well, the insurance company still has your grandfather listed as the owner on the policy. So I helped him get that changed to him being the owner and the insured. It wasn't hard, actually. Thank goodness. It wasn't difficult. But we just had to supply a death certificate.
Got it.
But I said, let me tell you about this policy. And he goes, yeah, I have no idea. And I said, well, it's got this much death benefit. It's got these living benefits. If you're terminally ill, chronically ill, critically ill, does these things. And I said, now, every time you're making a premium payment, some of that money's covering the cost of the insurance, and some of it's going into a little savings account. And that savings account currently has, I want to say it was like $7,000 or $8,000, whatever. It wasn't a huge sum, but it was something. And he goes, you've got to be kidding me. It's got that much money in it? And I said, yeah. He goes, well, my dog needs to get surgery, and I didn't know how I was going to pay for it, and this will be enough to pay for my dog to get the surgery. That now, I'm a dog lover.
Wow.
I'm a softie when it comes to dogs.
Wow.
So I'm almost like, I just love dogs. I just almost start tearing up like, wow, this kid, loves his dog. Didn't know how he was going to get the surgery, and this cash value is going to give him the opportunity to do that. And it just, that felt better to me than almost any. I've had a lot of great, happy clients over the years. That one felt the best.
Wow.
Yeah.
That's amazing. Thank you for sharing that, Bill. That is amazing. And it's important. A lot of people don't know what they have or what they inherit from somebody else. And that is amazing. This is my last question. For the new agent that wants to get into this business, specifically retirement solutions, what are some things you will recommend to that agent to have success in this business?
That's a great question. So, first of all, there's a lot of different ways that people get their foot in the door in this business. Mine was mortgage protection, and I know you guys do a ton of Medicare and health insurance and that type of business. So, first of all, I would say, you need to learn the basics of however it is that you're getting your foot in the door. Like sometimes people will get their foot in the door with Medicare or mortgage protection or whatever, and then they hear some of our stories about some of the big premiums that we write on annuities or IULs, and they think, oh, I want to go chase that. It's not for beginners. Now you don't have to wait a year and a half like I did to start selling those products, but 3 to 6 months is not ridiculous based on learning the basics of whatever it is that got you in the business to begin with. Now once you kind of feel comfortable with those basics, then for the folks that work with us at Equis, we've developed a fantastic library of trainings that explain the index concept. Like, okay, the S&P 500 went up 15% this year. What does the math look like that turns that into cash value inside of the policy? How does that work? So we've got a lot of videos that explain that indexing concept, that explain, how to run quotes. That's one of the great things to do, is just play around with your favorite carrier's quoting software and start running illustrations on yourself or your children or your nieces and nephews or who, just playing around with it and seeing. And we've got instructional videos on how to do that. So, jumping into doing that stuff, in Retirement Solutions, we do what we call a podcast every week, and we invite all the Equis agents to attend that. They're going to get a lot of opportunity to learn from that. But one of the best things to do, in my opinion, is get started with joint work. So just like that very first annuity that my wife dug up for me from a mortgage protection sale, where I went out and sold that first one, she knew that she didn't know enough to try and sell that on her own. So she went to a specialist. Just so happened her husband, me, was the specialist. But, she asked a simple question in that appointment. She said, tell me about the returns that you're getting on your retirement planning and the risks that you're taking. Are you happy with that? Because we help people with that. And she found a need in that client. No, we're not happy. Well, we have a specialist in our office. Turns out it's my husband, but we have a specialist. I'll have him come out tomorrow night and show you a way that we can stop the bleeding, stop the losses in that current retirement plan that you have, and give you something that'll allow you to share in the gains in the good years, but you'll never lose anything in the bad years. Now, that's not hard. Any agent can say that, right? Yeah. So now, then you pass it off to a specialist on the team and go with the specialist on the appointment, whether it's face-to-face or virtual. Join the specialist on that appointment and get field training. Now, you're going to split the case with the specialist. Although when I served as the specialist, the person that referred that business to me never split the cases with me. She kept all that commission. I did, my wife. But you're going to learn a lot more by watching someone else experienced, write a few of these up and help a few folks. And then eventually, after you do that a few times and you come to some of our trainings that we offer, you get on our weekly podcast, you watch the training videos that we have, it'll be a process. It could take a couple of months, but as you soak all that in, some agents move faster than others, but next thing you know, people are feeling, I could do this. I can do this. It's not that hard. And it's just like anything. When I learned how to ride a bike, I knew I was probably going to crash that bike the first time I got on it without training wheels, right? Yeah. But I did it anyway because I wanted to ride without training wheels. And I did. The first 2 or 3 times I got on the bike, I crashed it. I probably bloodied up my knees a little bit or my elbows or something. But I kept getting on and doing it until I finally rode that bike by myself. Yeah. And that's what you were saying this earlier. Agents are afraid to go through that bloody process. Like, you might go on an appointment or two, after you spend some time with a specialist and you get where you think you're ready, you still might go on an appointment or two where you don't just nail it perfectly. You make a mistake or two and you're bloody in your knees, but you just keep trying and trying. You don't sit there and go, well, let me read a manual about bike riding and then I'll get on. And, nobody reads a manual about it. Nobody watches a YouTube video. They just jump on the bike and try and make it work. And that's one of the best ways to be successful in any part of the insurance business. Just jump on the bike and keep doing it till you don't crash it.
Yeah. Awesome. And honestly, that's how it works, right?
Yeah.
Because you do your first case, then you do your second, then you do the third, and then you feel, oh, I got this. That's how it happened to me, right? I just had the willing to go out there and start writing business, and that's how I actually learned it. And in the
then the
meantime,
confidence comes.
yeah, and then in the meantime, you have a mentor that helps you answer some basic questions while you're at it, but you just have to go out there and do it. So
That's it. Yeah.
awesome. Thank you so much, Bill. You've been great. It's been great. This guy, isn't he amazing? All the knowledge that he has and he is able to pour to our agents. So we're going to have him for a 2-day boot camp. So hopefully you register for it. It's going to be amazing. I want to thank you, Bill, for this time in our podcast. And hey, if you have an agent that wants to learn more about IULs, make sure you share this podcast with them. Make sure you contact us for more information. And hey, I see you all on our next Ideas Edition podcast. Take care.